We're looking at Nebius Group NV, ticker NBIS, and right now in the pre-market session, shares are surging. The stock is currently trading at 114.36, which is a significant jump of 4.41 or just over 4% from its previous close of 109.95. This pre-market action is already setting the stage for a very volatile trading day. Now, most traders might see that 4% pop and think it's just spillover momentum or perhaps a reaction to a broader sector lift. But what's really happening under the surface is a fascinating tug-of-war. This isn't just random buying. This pre-market spike is happening on surprisingly thin volume, which suggests a large bid order might have triggered a cascade, or worse, it's a setup for a morning liquidity grab. The expectation is that Nebius is finally breaking out of that $110 to $114 channel it's been stuck in, as we see on the one-day chart. The reality, however, is that this move might be far more fragile than it appears, and it's directly related to the increasing cost to borrow shares. The common belief for months has been that Nebius, given its market position, is a steady, if somewhat boring, compounder. Investors look at its PE ratio, sitting at a hefty 88.29, and see one of two things: either a dangerously overvalued company or a high-growth machine that the market has fully priced for perfection. The 52-week range, stretching from a low of 17.38 to a high of 141.10, tells you this stock has been on a wild ride. The current narrative, especially on platforms like X, formerly Twitter, is that the pullback from 141 was an overreaction and that 110 is the new solid floor. But this narrative conveniently ignores the fundamentals. A PE of 88 in this interest rate environment is not just optimistic, it's demanding flawless execution. The reality is that the company's path to justifying that valuation is getting narrower, not wider. Let's break down the recent price action because it's instructive. Looking at yesterday's intraday chart, the stock opened strong, hitting a high near 117 before lunchtime, but it just couldn't hold. That 10 a.m. spike was met with heavy selling pressure, driving the price all the way down to the 109 level by 1:30 a.m. This is a classic failed rally pattern. The rest of the day was a slow, agonizing crawl with the stock trying and failing to reclaim the 112 and 114 levels. It finally settled at 109.95 near the low of that session's sell-off. This tells us that sellers are active and aggressive at higher levels. That 4% pre-market pop we're seeing right now, it's heading right back into that same wall of sellers that were active yesterday. Volume is key here. Yesterday's volume was relatively average, which suggests the big institutions weren't committing en masse to either side. They were letting the algorithms and day traders battle it out. This morning's pre-market volume is, as I mentioned, thin. This means the 114.36 price point could evaporate the second the opening bell rings and real volume floods the market. Macroeconomic factors are not helping either. With uncertainty around inflation data and the Fed's next move, high PE stocks like Nebius are the first to get hit when risk-off sentiment takes over. The market is rewarding tangible, near-term profits, not long-term stories, and Nebius's PE ratio makes it a poster child for long-term story. For those who might be new to the name, what exactly is Nebius Group NV? It's often categorized within the technology or cloud infrastructure space, but its business model is more nuanced. Nebius Group focuses on high-performance computing solutions and complex data processing. They provide the backbone for large-scale AI modeling, scientific research, and enterprise-level data analytics. Think of them as a specialized layer on top of the traditional cloud providers. Their clientele isn't small businesses. It's research institutions, governments, and Fortune 500 companies that need massive, secure computing power. This specialized niche is why it commanded such a high valuation in the first place. The total addressable market is substantial, and Nebius has built a reputation for reliable, cutting-edge infrastructure. Looking back at its performance, the run-up from 17.38 to 141.10 over the past year was fueled by a series of significant contract wins and a broader market euphoria around AI and big data. Quarterly earnings reports have been a mixed bag. While they've consistently shown top-line revenue growth, margins have been under pressure due to the high cost of R&D and hardware acquisition. The last earnings call was particularly telling. Management was optimistic, but analysts keyed in on the rising capital expenditures. This is the crux of the problem. To grow, they must spend, but the market is punishing high-spending, low-margin growth. Let's talk about something that isn't readily apparent on the surface, but is crucial to understanding this 4% pre-market move: the short interest. Nebius has become an increasingly popular target for short sellers. While the public float data is updated bi-monthly, the chatter among institutional brokers is that the cost to borrow Nebius shares has been ticking up steadily over the past few weeks. This is a red flag. A rising borrow rate means demand to short the stock is increasing, and the supply of shares available to lend is shrinking. Why are they shorting it? The thesis is straightforward. They are betting against that 88 PE ratio. They look at the company's capital-intensive model, the slowing, though still positive growth in its latest report, and the broader macroeconomic headwinds, and they conclude that the stock is fundamentally mispriced. They believe it's a $70 stock trading at $110. We don't have a major public report from a well-known short-selling firm at this moment, which means this is a more quiet, institutional-led shorting campaign. It's the smart money making a valuation-based bet, not an activist short alleging fraud. This is in many ways more dangerous for retail longs, as it's a slow, persistent pressure rather than a dramatic, news-driven event. How can you track this as an investor? You need to look beyond the basic stock chart. Services that track short interest, or even data available through some high-end broker platforms, provide daily estimates of short interest and, crucially, the cost to borrow. When you see that cost to borrow spiking, it means shorts are willing to pay a high premium to bet against the stock. Another metric to watch is days to cover, which is the total short interest divided by the average daily volume. A high days to cover ratio can sometimes set the stage for a short squeeze, but with Nebius, the volume is high enough that it's less of a squeeze candidate and more of a heavy blanket on the stock price. What's your take on this rising short interest? Is it just the market correcting an overvaluation, or is it an organized effort to suppress the price? Let me know in the comments. So, if you're holding this stock, what's the actionable insight? First, recognize that this 4% pre-market pop is heading into a wall of resistance, both from yesterday's sellers and from these institutional shorts who would likely use this strength to add to their positions. Don't be surprised if this gap up is faded by 10:30 a.m. Second, monitor the volume at the opening bell. If the stock opens near 114 on massive sustained buying volume, the shorts might be in trouble. But if it opens and the volume is weak, or the price immediately starts to fall, it confirms the thin pre-market move was a trap. We are seeing some chatter on Reddit forums about NBIS, but it hasn't reached the meme stock fervor. The discussion is more measured, with many retail holders frustrated by the stock's inability to hold gains. They see the 141 high as the true value, and everything else is manipulation. The reality is that 141 might have been the anomaly, the moment of peak euphoria, and the current battle is to establish a new, fundamentally sound base. Investors should be wary of calls for a squeeze. This setup does not look like a classic squeeze play. The shorts are not trapped. They are placing a calculated bet. Trying to fight them based on hope is a good way to lose capital. Instead, focus on the company's next earnings report. That will be the real catalyst that either validates the short thesis or proves them spectacularly wrong. Looking forward, there are a few distinct paths for Nebius. The bullish scenario is that this pre-market jump is the start of a real breakout. It would require the broader tech market to catch a bid and perhaps some unexpected positive news from the company, a new major contract or an analyst upgrade. If it can break and hold 115 on high volume, the shorts will have to start covering, which could fuel a move back towards 120. The bearish scenario, which seems more likely given the short-selling data and the weak technical close yesterday, is that this 114-115 level acts as a ceiling. The stock gets rejected, and we spend the next few weeks retesting the 109 support. If that 109 support breaks, there isn't much to stop a slide back towards the 100 level. The most critical factor will be the company's next quarterly update. They must show that they can control capital spending while still growing revenue. If they can improve their margins, that 88 PE ratio starts to look a lot more justifiable, and the short thesis will crumble. But if margins compress again, the shorts will be proven right and the stock have a long way to fall. It's a binary bet on execution. The company has a solid market cap of 2.76 CR, which means it's a significant player. It's not a small cap gamble, but it's priced for perfection in an imperfect market. I'm curious what everyone watching thinks. Comment below what your average cost basis is on Nebius Group, if you're holding it. So, to wrap this up, the expectation set by this 4% pre-market surge to 114.36 is one of renewed bullish momentum. But the reality is far more complicated. This move is fragile, running directly into a zone of heavy technical and short-selling resistance. The narrative that this is a simple buy-the-dip opportunity ignores the fundamental challenge of its high valuation and the persistent quiet pressure from institutional short sellers. The real story isn't the 4% pop, it's the battle for control between the valuation-focused shorts and the long-term growth believers. The next few hours of trading will be incredibly telling. This is a stock at a crossroads, and the data suggests caution is warranted.